Welcome to this explainer. Okay, we are jumping right into one of the largest, most foundational, and honestly, most misunderstood financial instruments out there, the global bond market. It is literally massive. We're talking well over $100 trillion. To put that into perspective, that makes the bond market even bigger than the global stock market, right? But despite that enormous footprint, a lot of people just write bonds off as, well, boring, or they just tunnel vision entirely on stocks. By the end of this, we're going to completely change that perspective.
So how do you fund your biggest dreams without risking it all? It's a really serious question. Because if you're an everyday investor trying to confidently save up for a major life milestone, you might be absolutely terrified of riding out the extreme, stomach-churning volatility of the stock market. You need something predictable, something that actually lets you sleep at night, while your money is still out there working for you. Okay, let's dive right into our roadmap for today. First, we'll meet Maya and look at her future goal. Then, we'll cover what exactly a bond is, break down the core vocabulary, figure out why companies actually issue these things, and finally, look at balancing your portfolio. We're going to take all this confusing financial jargon and turn it into a practical, powerful tool. Section 1. Meet Maya's future goal. Planning for the next decade. To really wrap our heads around bonds, let's look at Maya. She's a totally relatable beginner investor, and she wants to save up for a huge purchase, specifically a house. But she desperately needs a safe, predictable way to grow her money without those wild, unpredictable stock market swings. So her timeline looks like this. Today, she starts investing. Over the next 5 years, her goal is to generate predictable income, and then in exactly 10 years, she uses that money to buy her dream house. Now, to pull this off, she can't just cross her fingers and hope the stock market happens to be up a decade from now. She absolutely needs a reliable vehicle to generate income over a very specific time frame.
Section 2. What is a bond? The simplest definition. To help Maya achieve this decade-long plan, we first really need to define what this instrument actually is. At its absolute core, in the simplest possible terms, a bond is just a loan. That's literally it. It's simply a loan from an investor to a borrower. And there's a really crucial distinction to make right here. When you buy a stock, you become a partial owner of that company. You get to ride the highs of business growth, for sure, but you also eat all the risks, and you could face massive losses if the company tanks. But when you buy a bond, you become a lender. You are a creditor. Stockholders are owners, bondholders are creditors. It's a completely different relationship. So while bonds generally hand you lower returns than stocks, in exchange, you're getting a whole lot more stability. Section 3. Core bond vocabulary, the mechanics of lending. Let's see how this builds into the specific terminology Maya actually needs to know to buy her first bond. First up is principal. This is simply the original amount of money borrowed by the issuer and lent by the investor. So for instance, if Maya goes out and buys a government bond worth $1,000, that initial $1,000 she hands over, that is her principal investment. Next, we've got maturity. This is the predetermined date when the borrower has to return that original principal back to the investor. And connecting this right back to Maya's goal, she can actually go out and deliberately pick a bond with a 10-year maturity date that perfectly lines up with exactly when she needs that original cash back in her hands to make the down payment on her house. And then, of course, we have the interest payment, which in the bond world is usually called the coupon payment. Let's say Maya's bond offers a 5% annual interest rate. Well, 5% of her $1,000 principal guarantees Maya a super predictable $50 a year in income. Every single year, for a decade, she gets $50. After 10 years, she's pocketed $500 in interest, plus the government hands back her original $1,000 principal.
Section 4. Why companies issue bonds, the borrower's perspective. Okay, so we clearly see the perk for Maya, predictable income. But why on earth would a massive corporation actually want to borrow Maya's money? Let's walk through the corporate logic here. Imagine a tech company that's building some revolutionary new product. Step 1, they realize they need $1 million to expand. Now, they could just sell ownership shares of stock to get that cash. But in step 2, they decide they really want to avoid doing that. Why? Because they want to keep control and ownership tightly concentrated among their current shareholders. So, step 3, they issue bonds to borrow the cash instead. The company gets the capital it needs to grow, and the investors get their sweet, sweet interest payments.
But hey, it's not just tech companies out there borrowing money. Who else borrows? Well, national governments use bonds to fund massive public infrastructure projects and services. Local municipalities issue them for everyday things like community schools and paving roads. Corporations, as we just saw, use them for business expansion. And then We have high-yield issuers. Now, while some bonds, like those from a stable national government, are incredibly safe, these high-yield bonds, sometimes charmingly called junk bonds, carry a much higher return potential, but they also come with a significant default risk. And default risk is exactly what it sounds like. It's the very real possibility that a struggling company might actually fail to make the required payments to you. Now, here is a super common misconception. A lot of people think bonds are just totally static, like their prices never change. But the absolutely crucial point you need to remember is this. When market interest rates rise, existing bond prices usually fall. It's a complete inverse relationship. Think about it. Let's say you own a bond paying 5% interest. If brand new bonds suddenly hit the market paying 7%, nobody wants to buy your 5% bond anymore. As all the demand shifts over to the shiny new higher paying bonds, the value of your older bond declines if you try to sell it before maturity. So yes, bond values absolutely do fluctuate based on market conditions.
Section 5. Balancing your portfolio, the big picture. Let's step back from the pure mechanics for a second and bring this whole story back to the everyday investor. Let's look at how bonds actually act as this incredibly powerful stabilizing force within a broader wealth generation strategy. Check out this theoretical, balanced approach. An investor who holds 100% stocks, yeah, they might reap in the highest returns during a booming economy, but they are going to feel the most painful, brutal losses during a market crash. Someone holding only bonds gets tons of stability, but way lower growth. But investors see here, they seek balance, just like Maya. By splitting their portfolio into 60% stocks and 40% bonds, they get to combine the aggressive growth of stocks with the reliable, steady income of bonds. Plus, during economic downturns, investors typically do what's called a flight to safety, which drives up the demand for bonds. And that helps investors comfortably survive those scary economic shocks, because having that bond allocation seriously reduces their overall portfolio fluctuations.
Which brings us to our final thought to close out this explainer. Are bonds the missing piece in your financial foundation? Look, bonds rarely make flashy headlines, and they generally aren't in the business of creating overnight millionaires. But they are absolutely a fundamental building block of the entire global financial system. So I want you to reflect on your own financial goals today. Could utilizing this remarkably simple agreement between borrowers and lenders be the exact key you need? The key to adding that income, stability, and diversification to your portfolio so you can confidently achieve your dreams just like Maya? Thank you so much for joining me today, and keep learning.